Hi everyone, welcome back to Whiteboard Circuit, and I'm here again with you to talk about a new business term. And the business term today is disposition effect. If you haven't watched the other videos in this business term playlist, go ahead and click the playlist above. Watch those videos, learn all the terms, and become the smartest in the room. So today, I'm going to talk about the disposition effect, which is a very financially used term, but it could be used in other scenarios as well. So what is the disposition effect? The disposition effect essentially takes account into emotions when we have to make a very logical, rational decision. So in the last video, we talked about bias, confirmation bias, and it's kind of similar, but it's more has to do with risk balance. So let's say we're investing, right? And there's two ways investments can go. We can either lose money or we can gain money. So I'm going to call it loss and let's say win. So let's go lose or win. So you can either lose or win. Now, what happens is how we should be ideally investing if we were to invest is to look at the facts. Look at the earnings of the company. Look at their R&D progress. Look at their trend, their stock trend, their market trend. And our decision should be purely based off of how the company is performing. Now, let's say we invested $100. I'm saying 100 just to keep the percentages simple. And we lose 5% versus gain 5%. So once we lose 5%, we have 95 here, $95, and here we have $105. Now, what often happens is once we start losing money, now of course $100 isn't too much in the world of finance and investing, but once we start losing money, people start panicking. And when they panic, they lose sight of this. But same goes to this side. When people start winning money, it can go two ways. Maybe they get greedy, or maybe they are like, okay, I've got money, I should come out. Like they become too happy to hold and make rational decisions. So in both cases, emotions will get involved. So the disposition effect essentially states that people often hold on to losing investments longer than they should and sell winning investments earlier than they should. Now, what does this mean? Let's say we lose 95. We think, okay, it's okay, we can make it up again, the stock could raise, right? Because stocks, they're volatile. What determines this, whether a stock's gonna go up or down? It's not how much you lose or gain, it's all of this. If the earnings are good, if the progress is going well and market trend is always increasing, then it's more likely to go up. But if these start dropping, if the statistics of the company aren't as good, the stock's gonna go down. So whether we lose or gain money is purely based on these. And then of course you have the buying, selling, and Wall Street and that aspect of it. But this is essentially what states whether a stock will go up or down. But when we start losing money, we keep thinking, oh, let's keep holding it, it'll go up. But sometimes what happens is a stock can do this. It just keeps dropping. There's no gain to it. And then we're here at 95 and we're like, no, maybe it'll go up. Let's keep holding it. Drop down to 85. It'll still go up. Let's actually buy more stock so that if we were to raise it, we could, even if it were to go up to here, we'll be able to make some profit or at least break even. So you buy more, you put in more, and stock keeps dropping. But we forgot to study this. If this was all negative, we should have sold right here and made a $5 loss and just left the stock alone and just called it a day. Sure, we lost $5. That's okay. But doing this makes us lose much more money. And because we brought in our emotions and we lost sight of what is really the facts, what the statistics show, we end up losing a lot more money than we should have. So the first part of the disposition effect is oftentimes because we have hope, because we just want to make more money, because we think that the stock might go up, we end up holding our losing investments longer than we should. Now, the second part is the exact opposite. We end up holding our winning investments less than we should. We sell them early. Now, why is that? Now, let's say you just came out of this stock at a $50 loss. You held it way too long. You knew it was going to fall, but you kept holding it. You kept holding it in hopes. And one time you're just like, you know what? You sold it for $50 loss. Now, your winning investment. Now our stock, let's say the stock goes like this. We know it's going to go like this. And we're at 105 and it goes, we're at 100 and we goes up to 105. We think, okay. Then it goes up to 120. Now we're like, oh wow, we almost made half of what we had lost back. It goes up to 40. Now you're like, you know what? I'm going to sell. I don't want to risk it. So you sell at 140, right? You almost made back all of your loss and now you're happy. But then you watch the stock and it goes up to 180. And you're like, wait, why did I sell so early? I should have just waited. But if you would have seen that the earnings, the research and development, the market trend, it's all increasing, everything is going up, maybe you wouldn't have sold. Because of that emotion, because of the fact that we made back the money and because we didn't want to risk it, we were scared, we made profit, let's just get out of it. We sold too early, even though the facts, the statistics showed that it was going to rise more. So that's what the disposition effect is. Essentially, we keep our losing investments longer than we should in hopes that they will go up. And we sell our gaining investments too early because we get excited at the profit and we don't want to risk it. So a lot of these terms I talk about are very heavily based on your emotion. If we were to put aside the human aspect, the empathy, the emotion, the bias, and just look at pure straight facts and statistics, then maybe we would be able to cut our losses and gain more profit. If we were to build a computer program, or if we were to become like a robot, no emotions involved, we lose $5, we lose $5. We gain $10, we gain $10. There's no greed, there's no emotion, there's no hope, there's no risk, there's no scared factor. It's just purely based off of statistics. I feel like a lot of people would be significantly better at trading and investing than when human emotion comes into play. But again, I'm just a college student. I'm just trying to do my own research and learn how the stock market is. And I make these videos so that we can all learn together. So that's a quick disclaimer. I know I talked a lot about finance and maybe even said, maybe we should do this, we should all do this. But again, just a college student. I'm not a financial advisor. So please do your own due diligence and research before getting into investments. But I hope you liked this video and thank you for listening. If you like this video, press that thumbs up button and that subscribe button and put down a comment if you want to know any other business or finance term. So I hope you enjoyed. Bye.